The week is about to end, maybe with the most characteristic move in the markets being the weakening of the US dollar. In the coming week, we note on the monetary front BOE's interest rate decision on Thursday, while statements from policymakers from various central banks could sway the market's opinion. As for financial releases, we make a start on Monday with UK's GDP and manufacturing output growth rates for July. On Tuesday, we note the release from Japan of the corporate goods prices growth rate for August, UK's employment data for July, German CEF indicators for September, and we highlight from the US the release of August's CPI rates. On Wednesday, we get from Japan the machinery orders for July, UK CPI rates for August, Sweden's CPI rates for August, and Eurozone's industrial output for July. On Thursday, we note the release of New Zealand's GDP rate for Q2, Japan's trade data for August, Australia's employment data for August, Canada's number of house starts for the same month, and from the US we note the release of the weekly initial jobless claims figure, the Philly Fed Business Index for September, the retail sales for August, and the industrial production for August. Finally, on Friday we note the release of China's industrial output and retail sales for August, as well as UK's retail sales for the same month, and from the US the preliminary University of Michigan consumer sentiment for September. The USD is about to end the week lower against its counterparts after 3 consecutive weeks of gains. It should be noted that the US employment report for August had mixed signals, as the release showed that the US unemployment rate jumped to 3.7%, while the NFP figure dropped to 315k, easing some market worries for the Fed's hawkish intentions. Yet on the other hand, the unexpected rise of the ISM non-manufacturing PMI figure for the same month tended to reaffirm the bank's narrative that the US economy is not in a recession, and some areas of it are still performing well. The release more or less tended to imply that the Fed has some leeway to proceed with an aggressive stance regarding its monetary policy tightening, and provided renewed support for the US dollar. It's characteristic of the Fed's intentions that Fed officials more or less tended to remain hawkish, given that they still consider that inflationary pressures in the US economy seem not to have peaked. We'll be getting more clues on that on Tuesday, as the US CPI rates for August are due out and could generate substantial volatility for the markets. Nevertheless, Fed Board Governor Brainerd stated that we are in this for as long as it takes to get inflation down, while Cleveland Fed President Mester stated that more rate hikes are required, reminding the markets of her past statement that the interest rate could surpass 4%. It should be noted that Fed Chairman Powell also backed the hawkish stance of his fellow policymakers on Thursday, practically reiterating his Jackson Hole commitments. Please note that we are entering a period where Fed policymakers are to refrain from making any statements in expectation to the Fed's interest rate decision on the 21st of September. Overall, we expect the market's expectations for the Fed's intentions to continue to guide the US dollar in the coming week as well. The pound is about to end the week higher against the US dollar and JPY, yet remains weak against the euro. Before we start, we would like to note the passing of Queen Elizabeth, marking the end of an era for the UK. On the fundamental level, we note the election of Liz Truss as the new leader of the Conservatives and her appointment as the new Prime Minister of the UK. The new PM's first bill seems to be a legislation freezing the energy costs of UK households to £2,500 per year, with similar reliefs also being available for UK businesses. The plan is to be financed by public debt and could cost around £100 billion, with an additional £50 billion for UK businesses. In addition, the newly appointed Prime Minister wants to provide liquidity to energy providers of around £40 billion in total. Overall, Truss's plans seem to be costly, as they do not seem to be targeting specific groups, while they may also have a calming effect on inflation and on BOE's monetary policy. We note that BOE Governor Bailey on Wednesday defended the bank's actions of raising interest rates in order to curb inflationary pressures. The bank's next interest rate decision is to be released on Thursday, and the bank is expected to hike rates, yet the question remains by how much. Until Wednesday, the bank was expected to proceed with a 75 basis points rate hike, yet today, GBP/ORS implied probability of 57.22% for the bank to proceed with only 50 basis points rate hike. Should the bank proceed with the former rather than the latter, we may see the pound getting some support, while a 50 basis points rate hike could also be beneficial should it be accompanied by a hawkish, confident tone foreshadowing more rate hikes to come. On the other hand, we would note that the pound traders may also be interested in financial releases, given that a substantial number of them is due out next week. JPY is about to end the week lower against the US dollar, reaching a new 24-year low, but also weakened against the euro and the GBP. The Japanese currency has reached very low levels against the US dollar, given also its sensitivity to US yields, and the market is pondering whether a possible market intervention from Japan to defend its currency is imminent. Japanese authorities are watching the situation with a great degree of urgency, and it's characteristic that Japan's finance minister Suzuki expressed his concerns about the recent currency moves, which he described as somewhat one-sided and rapid. He also stated that the negative aspects of the yen's weakness should be monitored. Deputy Chief Cabinet Secretary Kihara said on Thursday that if such moves continue, we would like to take necessary action, according to Reuters. Yet a market intervention operation may prove to be difficult, as such an action may not keep the yen afloat for a prolonged period, given that monetary outlook differentials may weigh once again. It should be noted that BOJ's dovish stance seems to intensify the issue, while the bank proceeded with a boost in buying of Japanese government bonds as the yield approached the ceiling set by the bank at 0.25%. The move was indicative of the bank's dovish intentions and determination. Overall, we tend to maintain our worries for the situation, yet on a more fundamental level, we would also like to note JPY's dual nature as a national currency and a safe haven, which could alter the currency's direction in times of distress. The single currency is about to end the week with gains against the US dollar, GBP and JPY in a sign of a broader strength. ECB's interest rate decision was the main event for euro traders for the week, yet we have to note that despite some uncertainty, the bank finally proceeded with a 75 basis points rate hike. The bank is expected to continue to hike rates in the future meetings, given that it stated in its accompanying statement that we raised the three key ECB interest rates by 75 basis points today and expect to raise interest rates further because inflation remains far too high. In ECB President Lagarde's press conference, it was mentioned that determined action had to be taken, yet that the 75 basis points rate hike is not to be the norm. Furthermore, we have to note that the bank's decision was unanimous, refuting the notion of a power struggle within the bank. Nevertheless, ECB's interest rate decision failed to excite euro traders. On the contrary, the common currency traded lower after the release, possibly on market worries for the growth of Eurozone's economy and member states' level of debt. The issue may continue to weigh on the euro, given that Russian supply of fuel has been cut and could have a detrimental effect on the economic recovery of the zone. Thus, the possibility of a recession seems to be on the horizon, if not already present, for the area's economy. Also, please bear in mind that today EU's energy ministers are to convene in an effort to form a common energy policy, yet that seems to be still in the distance, given that disagreements of member states like Hungary and Poland exist. Overall, we see the fundamental picture as being rather grim, with a cold wind ahead, which could weigh on the euro in the coming days. AUD is about to end the week lower against the already weak US dollar. It should be noted that the Aussie traders did not seem to be impressed by RBA's interest rate decision, at which the bank delivered a 50 basis points rate hike, as was expected. In his accompanying statement, RBA Governor Lowe stated though that the board of the bank expects more rate hikes to come, yet is not on a preset path, and the timing and size of future rate hikes is to be guided by the incoming data and the board's assessment of the outlook for inflation and the labor market. The last comment tended to create some slight disappointment among traders, as they may have expected a higher degree of decisiveness from the bank, while the market prices in another 50 basis points rate hike in its October meeting currently. Nevertheless, we highlight the weight placed by the bank on the Australian employment data, which are due out on Thursday for August. Should the employment figure remain in the negatives and at the same time that employment rate rise, we may see the Aussie slipping, as that could imply a crack in the Australian employment market. On the other hand, we highlight the situation in China for Aussie traders, given the high amount of raw materials exported from the land of Down Under to the Red Dragon. It should be noted that the NBS manufacturing PMI figure showed that economic activity contracted for the past 6 months, with a slight exception of June. Moreover, the struggling of Chinese factories was also reflected on China's August trade data, with the exports growth rate being slashed and the trade balance dropping by a whopping 22%. Without a doubt, China's zero-COVID policy and the extended lockdowns have a negative effect on Chinese manufacturing production. It should be noted that the negative effects were reflected also in Australia's trade data for July already, as the trade surplus was halved. On a more positive note, please bear in mind that Australia's GDP rate for Q2 accelerated to 3.6% year-on-year. However, that does not seem to warrant a follow-up acceleration for Q3. We tend to maintain the view that the situation in China may continue to affect the Aussie, while its second nature as a commodity currency could also make it sensitive to the market's unpredictable mood. The CAD is about to end the week relatively unchanged against the US dollar, yet we note that currently Canada's employment data are still to be released and could alter its direction. On the monetary front, we note the release of BOC's interest rate decision past Wednesday. The bank proceeded with a 75 basis points rate hike, raising the interest rate level to 3.25%, as was widely expected, while its accompanying statement mentioned that given the outlook for inflation, the Governing Council still judges that the policy interest rate will need to rise further, while QE tightening is to complement the hikes. The decision is considered as hawkish, and practically on a monetary level could continue to support the loonie. On the other hand, we have to express our worries for oil prices and the possible detrimental effect that drop could have on the CAD. WTI's price dropped to an 8-month low during Wednesday's session around the $82 per barrel level, as the aggressive monetary policy stances adopted by most central banks in developed economies weighs further on the possibility for worldwide economic slowdowns, intensifying concerns for a slowdown in the demand for oil as well. Practically, the market seems to be discounting the possibility of a recession hitting major oil-consuming economies, thus driving the demand of the commodity lower. In the coming week, we expect that given the absence of a substantial number of high-impact financial releases stemming from Canada, that the loonie may be affected by market fundamentals in the course of oil prices. Should the market sentiment improve and oil prices start to correct higher, we may see the CAD getting some support and vice versa. Overall, and as a closing comment, there's a high degree of uncertainty in the markets about the outlook of various national economies, but the global economy as a whole as well. The phantom of recession looms over the markets like Damocles' sword. Should market woes continue to intensify, we may see safe haven assets enjoying inflows, while riskier assets such as commodity currencies and stocks could weaken. Generally in the FX market, we expect the US dollar to regain some of its initiative over other currencies in setting the course in the troubled seas of the markets due to the high number of high-impact financial releases from the US, as well as the gravity of the consequences of the Fed's intentions in the international markets. As for US stock markets, we note that they have the first gains after 3 consecutive weeks. All the main US equities indexes, namely the Dow Jones, Nasdaq and S&P 500, were in the greens as the week draws to a close. Should the market sentiment improve, we may see US stock markets maintain their gains and even expanding them somewhat. Yet in the grand scheme of things, the outlook seems to remain bearish in the absence of a pivot to the upside. We highlight that gold's negative correlation with the US dollar seems to have been maintained as the US dollar was losing ground and gold's price rose higher. It should be noted that the rise of the US yields may have capped the precious metals ascent higher. In the coming week, we may see the shiny metals price continue to be driven by the US dollar and yields, and should the greenback weaken further, gold's price could regain some of the lost ground of the past weeks. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
Today we're going to learn about the role of central banks and the main functions that they perform. After the Bank of England's establishment in 1694, the UK government used to take out a loan and it acted as the government's banker and trustee, in particular when it involved raising money. As trustees, central banks often bought government bonds. The action is known as monetary financing, which is still used today. The most important responsibility of the central bank is the monopoly it has over the distribution of money. Having a monopoly over the supply of money means that a central bank cannot run out of money. Theoretically, a central bank can issue any amount of money it needs to meet its needs. Of course, an uncontrollable increase in the amount of money would lead to higher inflation, raising the cost of living and limiting any benefits of the economy. Because the central bank is able to issue an unlimited supply, it cannot really run out of liquidity. Another important role of a central bank is to act as the lender of last resort during periods of distress. Central banks should lend to banks which are solvent in order to avoid panic. This is unimportant as in general the main activities of commercial banks are to provide loans and obtain deposits from the public. As the money is lent out, banks only have a limited availability of cash to cover for deposit withdrawals. During the times of the Great Depression, when many withdrawal requests were made at the same time, the commercial bank did not always have the available funds to meet all withdrawals. Therefore, to avoid panicking depositors that they will not be able to get their money back, it borrowed from the central bank. That's why the central bank is known as the Bank of Banks. Stay tuned with us for a live webinar about trading strategy clinic with Desmond, and don't forget to visit the webinars page at IronFX website to subscribe to more webinars.
Okay, thank you guys for tuning in, right, on today's session on trade management, take profit, and stop loss placement. So I'm sure every one of us who are trading will want to know where's a good point to take your profit and where's a good point to take your stop loss, right? Because most of the time we know that sometimes it happens because it hits our stop loss and then flies to our take profit. So it's slightly a bit more frustrating when that happens. So in this session, I'm hoping that I can explain some of the methods that we use to place take profit levels and stop loss levels as well, right? To redefine or to define more specifically where you should put them so that you can take better profits. Okay, so today on IronFX, before we start, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. And before I start, right, maybe let me just bring you guys to, let me do a short introduction on some important websites that you guys should know, right, before I start the webinar. So on IronFX itself, if let's say you tune in later today and you miss out some parts of this session, you can go to our webinars, right? And you can go to, wait, let me see. I think you should be here. Okay, you should go to the webinar site. It usually should be here. Give me 1 second. Okay, platforms. Okay, we do record our webinars and our podcasts on the page itself. So you can come in to see all the past webinars that we have recorded. Okay, past webinars. Click here. If you miss any of the webinars and you want to have a refresher course, right? So if you want to listen to any of our English webinars, click on the English, and then you have all the past webinars that we have recorded here, right? Like our live trading session, our fundamental analysis, previous sessions on the Fibonacci. If you wanna take a look, yeah, it's all here. Okay, and I want to as well as tell you guys about our special VIP room, right? Especially for all the IronFX clients that we have. So in this VIP room, you have exclusive market forecasts. Okay, we will be posting some of our analysis from our prop traders as well as Desmond himself, right? So you can ask our experts anytime. I will show you guys how it works later on. So this is just a page to bring you through and as well as let you know where to register, right? So you can let us know what currency pairs or if you have any questions, we'll be live to answer, right? We'll be there to answer you, okay? So there are different premium services, different 5 tailored account types for you to choose from. So if you are already a member of the IronFX, you just have to deposit the sum to get you to different tailored account types, right? Okay, so you just click on this link here, access our VIP room. I'll paste the link here. Right, let me just paste the link here for everyone to see. Okay, just click on that link and you should be able to sign up. Okay, so this is how the VIP portal looks like, right? You have a section where you can chit chat with us. If let's say you have some questions about maybe different currency pairs, or where are some of our key levels, or where we should be looking at, right? Chit chat. Okay, and every day we will have news that we post, updated news or daily news, important news that we post here. Okay, the majors, your DXY, your Euro, your USD pairs, commodities, indices, crypto even. Yeah, so any currency pairs that you need, it will be here as reflected. So how do we actually use this VIP portal? So for example, we are looking at Euro USD, right? So, okay, just give the chart a minute to load, okay? So it will be this chart that you see, and then there will be all the tools that you require. For example, your Fibonacci, you can draw, and then you can type here, okay, hi, Annabelle, is that important reversal point? For example, if you're looking at okay, for example, if you're looking at this level here, let's see. Okay, so for example, if you're asking whether this is a key reversal area at the 38.2%, you can highlight, right, and link to this line, confirm, and you enter. So every time you post a question, we'll be able to see right here where exactly you're talking about, right? So you can toggle around, let us know if you have any questions about any currency pairs, right? It's very useful, it's very tailored service. So yeah, check it out. Okay, and okay, so that's all before I start the session. So let's, without further ado, let's just start the session. Okay, so that's me. I work for the Everest Fortune Group, right, which run the award-winning research firm finalist for Best FX Research 2019, 2020, 2021, and the finalist for Best Equity Research 2020, 2021. Okay, so the agenda for today will be talking about why stop loss and take profits are important. Why is it important to set both of them? Okay, both of them are as important, right? Your stop loss as well as your take profit levels. right? Why they are important. Okay, the anatomy of a trade, okay, is not only just about your entry, it's not only about your stop loss and placement. There are other factors as well affecting the trade, right? Fixed stop loss and take profits. Why are they not that ideal? Okay, dynamic take profit and stop loss placement. So we'll be teaching you how to make it a more dynamic way of placing your take profit and stop loss, right? Risk allocation. What is the ideal lot size, or what is an ideal percentage to set aside, right? This will be covered during today's session. So before I start, just to let you guys know, if you have any question, please feel free to post on the comment section, because I can see exactly, yep, I can see exactly on my left side of the screen, right? So if you have any question, just let me know. Okay. So why is it important to place stop loss and take profit? So maybe I ask the audience a question. So do you guys actually place stop loss and take profit levels, or you just let the trade run on its own? So you can be honest, because most times I have seen people who just enter a trade because they feel like, you know, they feel like their guts tell them, or maybe some of the support key resistance level tell them that it's going in a certain direction, but they have never actually thought of how much profit or how much stop loss they should put in every trade. So how many of you guys actually place stop loss and take profit levels? Let me know. Joachim, what about beginners? Yeah, actually even for beginners, it is a good habit to put all stop loss and take profit levels. Is important, right? I have some answers. I use them. It's important. So sometimes I put, but mostly it hit stop loss. I mean, that happens to most of us, but you still have to put because it's about risk management, right, Dipesh? Okay. So the reason why you have to put your stop loss and take profit levels is because, number one, of risk management, right? Managing stop loss and take profit help you to manage your trades more strategically, right? Instead of more emotional kind of trade, right? You strategize your trades, like how much stop loss and how much take profit is worth the time and aim and effort, or worth that risk for you to take. So risk management, what I mean by that is how to properly identify these values are important, because you need to know, identify your favorable opportunities and come to term or accept the level of risk that comes with it. So with proper use of stop loss and take profit levels can play a crucial role in preserving and growing your portfolio, right? Not only are you like systematically protecting your holdings by prioritizing less risky trades, but you also prevent your portfolio from being wiped out completely. Okay, so that's what I mean by you can identify and analyze properly before you enter a trade, right? Instead of just enter and then you think about your stop loss later. Okay. Number two, prevent emotional trading. So some of us, you know, when you trade, you get slightly more emotional. So when you have stop loss and take profit levels, it's sort of like your boundaries, a set of discipline, right? To prevent yourself from getting the account wiped out, right? Because a lot of us, we trade because of impulse or on impulse. So this is why some traders rely on a preset strategy to avoid trading under stress or fear or greed, right? Because these are very powerful emotions. So you do not want to impulse trade. Hence, you set your stop loss and take profit levels accordingly. And the last point, which is the most important point, right? It is very important to know whether your risk to reward is rational, or whether it's logical to calculate your risk to reward. You can't be risking $100 just to win a $10 trade, right? It just doesn't make sense. Okay, so your risk to reward has to be rational, okay, before you even take a trade at all. Hence the importance of stop loss and take profit levels. Okay, so some of the methods used to calculate stop loss and take profit levels. Number one, trend lines and support resistance levels. So support and resistance are core concepts familiar to any technical traders or any traders at all. These are the areas where price chart are more likely to experience increased trading activities, because as prices come to your support or your resistance, these are the key areas where most of the trading activity will happen, right? This is where the fight always happens. Okay, so be it buying or selling. Hence, traders who use this method typically set their take profit level just above the support level and stop loss right below the resistance level, if right below the resistance level they have identified. Okay, so if you are taking profit, you should take slightly lower, because you don't want to come here. When prices come here, they will fight, and it's very messy. You don't want to miss out like maybe 80% of your profit already. So usually for take profit wise, we will set it slightly lower, and if it's a stop loss, you want to set it slightly below, because you want to have some buffer. Okay, percentage method. Okay, this is useful as well. So instead of a pre-specified level calculated using technical indicators, some traders actually use a fixed percentage to determine their stop loss and take profit. So for example, if you want to close a position at maybe 5% of your 5% gain or 5% loss. So it's depending on what is your RR, what's your ratio of your risk to reward, right? How much you want to take. Okay, this is quite straightforward. And the last point would be moving averages and other indicators. So some traders, they monitor moving average closely, looking out for opportunities to buy or sell presented in a crossover signal. For example, like your RSI or your MACD, right? So they'll set a percentage or an amount of pips, like maybe 10 pips, take profit or stop loss. Okay, so these are some methods that traders use. For Omar, what is the recommended RR rate? I will come to that later. Okay, for different people, I mean, there are different reasons for different RR rate. Okay, so the anatomy of a trade. Okay, so a lot, like I've mentioned before, most of us, we actually enter a trade. When we do an entry, we forget all about our stop loss and take profit, because, for example, if I see a market moving in a ascending trend line, I will be very nervous, or I want to catch the wave, right? So I will just enter without thinking. I'll just enter right here, or maybe here. It's a good level. There's a breakout, and I urgently need to enter. I just enter a trade without thinking of what is my stop loss and what is my take profit, just because I want to be part of this action, correct? That is very risky. Okay, so we check off all the boxes. For example, our Ichimoku, we check off our trend lines, our breakout levels, but stop loss and take profit comes only after execution most of the time. So all this take profit and entry, take profit, stop loss are all as important. Okay, so anatomy of trade, there is entry, stop loss, take profit. Not only these three, there is also your break even point, your partial profit, right? Your idea invalidation, and cancel trade. These are all as important consideration. Oops. So the anatomy of trade includes all this, not just an entry only, right? So the rest of this will be covered in the rest of the webinars following trade management part 2, 3, 4, right? Okay, so remember, it's not only just entry, stop loss, and take profit, okay? All are as important. Okay, so Now let's talk about how we take profit and place stop loss in the most simple manner, most logical and simple manner. Okay. So usually when a trend comes along, right, there will be, you will have to identify your major resistance area and your major support area, correct? And these levels here are called the what? Magnetic. They are the magnetic areas because prices tend to be very attracted to them. Okay. So for example, when your price is moving up, should your take profit be exactly at the line here? Should your take profit be here? Or should your take profit, okay, let me just draw. Should your take profit be A or should your take profit be B? Can't see my chart. Are you guys looking at my chart? I'm not. Let me know in the comments if you guys can see what I'm sharing. Can you guys see here? Okay. Okay, then maybe Terence, there's something wrong with your screen because, yeah. Okay. Okay, so let me know whether your take profit should be at A or should it be at B. If let's say my trend is going this way, my trade is this way. Okay, I can see some answers. There are some A's, there are some B's, but the answer is none because if you are looking at taking profits, right, what you should be doing actually is point C. Yes, it should be before A, correct? Okay, because once it hits this level, there will be a lot of commotion going on, all the fighting, all the fights will be happening here. So usually I just want to avoid that. I will take my 90% and run off, right? Just leave the 10%, it's okay. Because you do not want a point to happen where just because for the 10% you wait for price to almost reach there, reverse, here you panic. You don't know whether you want to sell or you want to hold, correct? And then you hold, thinking that it will come back, bounce back, but nope, it went back down 50%, gone. So instead of taking 90, you take 50%. Okay, so usually take profit levels should be below the resistance or magnetic area. And for your stop loss, it should be slightly after, okay, because you want to have some buffer, correct? Okay, so what's some problem with fixed stop loss and take profit? Anyone else? So you know, some channels, they tell you that if your moving averages cross, you can actually place a trade to take 100, okay, let's say 10 pips above, and then place your stop loss 10 pips below. Okay, any idea why this is not the best or not the most ideal way of taking profit and placing stop loss? Okay, the reason why it's not good, although it's a disciplined way of taking profit and placing stop loss, it's not ideal because, like I've mentioned, most times prices will react to a certain point and reverse. So you don't want to be caught in a situation where you are like maybe at a 9 pips and then you are very rigid, or you just want to hit the full 10 pips and then it reverses, you panic, right? You don't want to be caught in a situation here. So that's the problem with your stop loss, fixed stop loss and take profit levels. Okay, so let's go to some examples. Okay, so this is the support level here that we are looking at because you have 2 points. Okay, so this kind of looks like a double bottom, right? So prices are always very attracted to key levels before a bounce off. Okay, so number one, nice support level here, nice. Okay, so here, because there's a breakout, we buy thinking that price will go up all the way. Okay, strategy has a fixed stop loss of 100 pips, which is all the way down here. Okay, this is my stop loss, which is right above. Okay. And then instead of going up, my price came down, touch my stop loss, right? Because it's 100 pips, right? Because my mentor told me it has to be 100 pips. So I fixed to 100 pips. Okay, so I stick to it. But it's tap out, hit my stop loss, and then it reverse in a direction. Actually, there's another slide that shows that it flew back to my take profit levels. Okay, so my point here being, since you know that your prices are always very attracted to your key magnetic levels or key levels, you should always place your stop loss slightly below these key levels to give it a buffer, right? So prices actually touch here and flew back to my take profit. Okay. Take profit should be also slightly below because you don't want to wait until you hit the important level and then the fight begins. Okay, you don't want to be caught in a crossfire. Okay, so in essence, when prices goes near the resistance, you should take profit before any commotion happen. This is the red zone. Okay, and then if you're coming back down where your stop loss is, you always give some buffer instead of placing it exactly at the crossfire area. Okay, it doesn't make sense. Okay, so another example. So here is clearly a strong resistance area where price has reacted off twice. As you can see here, bounce off once, bounce off twice. So if let's say you have a fixed 100 pips, which, like I've mentioned, your mentor or someone actually tell you, you should set it to this because of your simple moving average crossing, whatever it is. And then you stick to your 100 pips, which is here, take profit. Your price actually bounced off. This is what you get originally, 90%. 90% profit. But instead of this small gap here that you are waiting for it to touch, hoping that you'll come here, for the 10%, you actually miss the whole trade, right? So point being, always place take profits below, slightly below the key resistance area. Okay. So if you place your take profit slightly before the key resistance level, you would have been in a 90% take profit trade, right? So lesson here is don't blindly follow a fixed take profit target just because some foreign told you to. Although I think it's good discipline to set a fixed take profit and stop loss, but you should also act according to what the charts or what the market is actually reflecting to you, right? You don't want to be rigidly sticking to your 100% or 100 pips take profit, okay? So take profit placements the wrong way. Now here is the swing high, previous swing high, which is a major key resistance level. Okay, bought and have a long position this way. Okay, price reverse before the big resistance here. So if you would have set your take profit slightly lower, you would have made maybe a 99%. Okay, always place your take profit before key resistance and support, right? Okay. Oh, so this is the same example as I've done before, right? Nice support level. You think your price will go up, and then the stop loss is here. Hit your stop loss and fly up. So this is the same exact example that I have done before. Okay, what I mean by dynamic take profit placement. So maybe you guys can share with me how you what are some of the methods you actually do your take profit levels? How do you place where you take profit? Like, do you go by your risk to reward? Do you go by a ratio? And often do you actually change your take profit levels? Do you adjust them? Let me know in the comment section. Okay, yeah, it's very common for people to use the risk to reward. What are your risk to rewards then? I'm curious. So some people risk to reward will be 1 to 2, but usually that is quite hard to achieve. So unless you are scalpers, usually I don't think they might use the 1 to 2 because price fluctuates too fast. Okay, risk to reward and next psychological level. That's interesting. 1 to 1. 1 to 1 could work for scalpers. Okay, so what I mean by dynamic take profit placement. Okay, let's see. So as some of you have learned, in this section, I will just use Fibonacci as an easier way to explain what I mean by dynamic take profit. Okay, so right here in the chart, we can see, okay, the entry level. So if you are looking at a short position, your entry is here, your stop loss is placed here, right? So we enter a position here. Okay, prices actually came down. Right? Came down here. This is our by right a take profit level that we are looking at. Okay. But let's say prices actually, once you draw your, this is a, let me see. Okay, this is a 78.6% retracement because they draw here, right? So this is a retracement level. Okay. Oh, okay, wait. Sorry, let me re-explain this. Okay, I think what they meant here is, okay, so my Fibonacci is drawn here, correct? And then I'm looking to enter a position once it hits my Fibonacci level here, because usually price tends to reverse at these levels of retracement. So I'm waiting for an entry before the short position and my take profit being placed here. So point 1, my stop loss should be placed above the highest, slightly above or below the highest or the lowest point, right? Depending on whether you're long or short, okay? So you always need to have some buffer, okay, for your stop loss. And then point 2, if your stop loss, if your take profit level is here, maybe you want to take slightly before instead of exactly at the point, because John cannot see my drawings. Can the rest of you see my drawings? Okay. Okay, I think John, something wrong with your, yeah. Okay, so for take profit level, you always want to avoid the key resistance or support area. Okay, you always want to take before. Okay, but for stop loss, you always have to, it has to always be placed after because you need the buffer. So for take profit here, just now like I've mentioned, I have entered a trade here because it has hit my 78.6 feet level, and now my short entry is in. So what I'm trying to say here, in a sense of a dynamic take profit, is that if you draw a projection, or if you draw Okay, usually we use Fibonacci projection to project where prices might come to, correct? So if let's say you draw a projection here, and then it tells you that, hey, actually at a 78.6 projection level, there might be a reversal. Okay, so it aligns with your take profit before a key level, right? Because you do not want to be here, and just coincidentally, your projection tells you that you should take here. Yeah, then you should actually move your take profit slightly above. Okay, so my Fibonacci projection actually tells me to take profit here instead of here. Okay, let's see what happens. It hits exactly here at my 78.6 and does a reverse to my stop loss. Okay, so my point being, you can use other indicators to actually incorporate it to your take profit levels to make it more dynamic, right? Instead of just looking at support and resistance level. So I think Fibonacci is a good way, is a good tool to use to incorporate together with your take profit and stop loss levels, because you know it is a moving forward, or it's a forward looking tool instead of lagging, right? Lagging tool, because you have things like projection that can let you know in advance maybe price might reach here, right? So this is how we incorporate our Fibonacci to place a more dynamic take profit or stop loss. Okay. So stop loss, same thing. Okay, right here, entry, stop loss. I'm waiting for price to actually. Okay, my entry is here, and then I'm looking to take profit here. My stop loss is placed above. It is what we're looking for. So I entered a position. Okay, and you can see here, my Fibonacci expansion is telling me that, hey, your stop loss shouldn't be placed so close to your previous swing high, correct? So what this Fibonacci does is that it helps you to define, or helps you to further support and give you a more accurate place of where you should place your stop loss. So my Fibonacci tells me that, hey, my expansion, my negative 27.2% is actually slightly above where I placed previously, right? So I actually moved my stop loss right further, and you can see that, hey, it actually came here and then touch before it hits my take profit. Okay, so there are two ways. One is for your take profit level, and one is a dynamic way to place your stop loss. Okay, I will draw this again in case it's not very clear. Okay, so what I can see here is that I entered a trade. Okay, I'm gonna enter a trade once it hits here. Correct. Okay, hit my entry level. Now my question will be, where should I put my stop loss? Most people will think that stop loss should be placed here at your previous high, but what this webinar is telling you is that you should always have a buffer. But how much buffer? So this is where your Fibonacci or your other indicators come in to tell you, this is my expansion. It's telling me that, hey, my negative 27 is somewhere along this line. Okay, price tends to like to reverse off this area, okay, because this is a key level. And my 61.8% projection. Okay, so here. Yeah, my projection might be this. Okay, so my Fib projection might be this, and then my expansion is here, 27 and 61.8 projection. So this is a very key important area that prices might come to touch before it reverse. And what you should do is always place it above the important levels. Hence, you can see that the line, your stop loss, is placed slightly above your 27.2% expansion and 61.8 projection. So price actually really came here to touch before it bounced off. Okay. So this is how you actually make your stop loss more defined, more accurate, the exact points, instead of just saying that, hey, your stop loss should be placed maybe 5 pips or 1 pip above your key support or key resistance area. There are times where your FIP might not work, but it's good to give it a shot, you know, to try to spot all these important key levels before a reversal. Okay. Okay, now let's talk about risk allocation. So just now someone actually asked me what is the ideal RR, risk to reward. Maybe you guys can let me know what is your ideal percentage per trade for risk allocation. Do you guys risk 1%, 2%, 10, 20, 50, all in? Okay, I see some answers, 2%, 1%, well, 10%, that's quite a lot. Okay, it also depends on how much your pot is relative to the percentage, right? If it's like a 10,000 or like 100,000, 10% is actually a lot. Okay, okay, 2%, 1%, okay. Very commonly, people will risk about, I would say, this level here. Okay, so Omar is a high risk taker. High risk, high reward, I hope. Okay. So what I want to show you guys here is roulette. So all of you guys have used or played rather roulette, right? So there's 18 red, 18 black, and 1 green. So if I give you $1,000 now to actually bet on the roulette, how much will you put on a black win? Will you guys put all in the $1,000, or would you risk how much would you put if you are given a $1,000, but you can only play one hand? Will you all in? Would you put $200, $100? Okay, $100, so about 10%. Okay, we have some other answers, right? But typically, most people will be in a range of 100 to 200. Okay, all in, yeah, because it's not your money, right? Okay, my point being, if let's say I change the roulette table, right, to 32 black, now would you change your amount that you put? Will you guys change it to all in, or will you guys actually, there's a highly likely, there's a higher chance that you might put in more than your original, be it double or triple or more. My whole point is that most people will put in more if they know that there is a higher possibility of black winning, correct? Because instead of 18 now, I have 32. Your odds are higher. Higher odds, correct? So my point is, risk allocation often depends on what is the setup like. So if you have a very, very good setup with maybe your FIB levels, FIB confluence, there's a very good Fibonacci confluence. Your RSI is telling you that, hey, there's a divergence, or your stochastic is showing you that it's oversold or overbought. Okay, all this, if let's say the setup is really good, FIB confluence will give you 30%, RSI give you 30%, your stochastic or other oscillators tell you another 30%. This gives you a 90% odds of winning. So if I have a higher odds of winning, why would I not put in more, right? it's all depending on what is the setup like. Most of the time, we are waiting for a good setup before we place a trade. Okay, so risk allocation, in our opinion, is best gauged if there is a good setup on that particular trade. Okay, so the higher or the better the setup, the more we allocate a risk. Okay. Okay, so the last part to this webinar will be ideal lot sizes. Okay, so it's always depending on your account size. Okay, how many percent you are willing to risk, because it will affect the lot size that you trade often. Okay, so for example, if 50 pips stop loss, this is 50 pips, right? Stop loss, 0.1 lot, you lose $50. One lot, you actually lose $500. So it's always depending. You should always know how much you are willing to risk before you adjust accordingly. So I have, let's say if you guys do not know how to count, you can come to this page. Okay, for example, okay, I have calculated here. Depending on which currency pair, if you're not sure, you can use this, because our MT4, you have to state exactly how much or how many lot sizes you wanna place. So on a $10,000 account, if you are willing to risk 1%, your stop loss 30 pips, so you're risking $100, and this is the standard lot size. Okay, so if you do not know how to count your lot sizes, you can come here. Okay, if you're risking 2%, then it's a different lot size. So it's depending on what is the risk percentage, or what is the amount you are willing to take. What's your risk allocation before they show you the standard lot size. Okay. Okay. So in this example, a 50 pip stop loss. Okay, I think it's here. Okay. So 50 pip stop loss, 90 pip take profit, and 20 pip stop loss, 36 pip take profit. So which one do I make more? Let me know in the comment section. Can you all see? 90 pip take profit, 50 pip stop loss. Which one do I make more? This versus this. Let me do a quick calculation also. Okay, so which one do I make more? This one looks like it's a lot more actually, right? Based on the looks of it. Okay, I have some answers. Okay, the top, the bottom. Okay. Okay, so actually, okay, you do not need to know the lot size, because you just need to take your 90 versus 90 divided by 50 versus 36, your profit divided by your stop loss. So both give you a ratio of 1.8 to 1.8. Okay, so my point being, my point is, it's not about the amount of pips you make, correct? It's also depending on the lot size. That's why you ask. But it's not always depending on the number of pips that you actually made. I can make 1,000 pips, but actually my lot size is very big or very small. It affects your take profit, like the actual amount. Okay, so it's about the risk to reward of your trade. Okay, that's my point here. Okay, so I've come to the end of today's session, right? Do you guys have any questions for me? Okay, maybe I can go to some live charts actually. Wait, give me 1 second. Okay, let's just see. Okay, let's try. Maybe on a live chat. So maybe on a live chart, I can do some examples. Okay, let's do maybe euro. Okay, we can do euro. Okay, so for example, if you were to, obviously we have to identify a trend, right? It's going downward. Okay, usually people will want to, okay, most people will, let's say if I come to this area here and it's in a downward descending trend, most likely I will want to place a sell order, right? A sell entry here on the second touch. Okay, so let's say if we already entered here, where would your stop loss be? Let's say this is my short entry, my sell entry. Let me know in the comment, where would you, let's say if I'm placing a sell entry here, where would you actually place your stop loss? Would it be here? Would that be your stop loss at this tip here? Or would your stop loss be here? Right, remember, we always mention if you're placing a stop loss, it should always be away from your entry. Okay, slightly above the previous resistance, neither. Okay, if it's neither, where would be ideal to place your stop loss, in your opinion? Okay, some people use pips, some people use percentages. Yes, you can actually do that. So let's try to see whether there are any confluence zone. Okay. Okay, so for example, you can see here, right? I draw my Fibonacci retracement tool, and it's telling me that, hey, there will be a reversal maybe at this level, which is actually quite an important key level because it's the overlapping resistance, right? Because there are so many levels that came here, touch, rate, 0.1, 2, 3, 4, 5, 6, then break. So this is actually a very important level that we should look out for, which also is the 50% retracement level. So it means that if price were to come back, it might touch here before a it might touch here before it bounce off, correct? So what you want to do is, if this is such a key level, your stop loss should be placed slightly above. Okay, because you do not want to be in the commotion or in the fight zone. So I will place my stop loss slightly above the 50% retracement. Okay, as well as the overlapping support or resistance. Okay. So then, this is just for example purposes, how you can use your other indicators to help you redefine for a more accurate stop loss or take profit placement. So if let's say my sell entry is here, I want to take profit. Usually people will tend to take profit here, correct? Because previously, if I do not have all this, okay, if I do not have all these bars, okay, I can do a replay, but it might be a bit messy. Okay, so it will be here, correct? So your take profit should be somewhere at this level, correct? But like I've mentioned, because this is a key support level, you do not want to be caught in a crossfire. So you want to take profit slightly before. I mean, it's great that it actually hit our take profit, but most times, as we know, it always misses. So I tend to place my take profit slightly above. Okay, So if this is the key resistance or key support area, I will put it slightly above. Okay, in both ways, it actually hit our take profit as well. Okay, so this is just an example of how I would place my take profit and stop loss in a more dynamic way. You can use indicators like your projection, extension, expansion. Okay. What proof do I need to give access to a VIP room? I don't think you need any proof to access the VIP, but you do need to be you do need to sign up with IronFX as a client, right? Okay, so thank you guys for tuning in today on a Wednesday. Enjoy the rest of the weekend. I will see you guys in the next session. Bye.
My name is Emily and today we will look at candlesticks. You may have seen candlesticks on a chart, but if you don't know how to use them yet, here is some useful information to help you get started. In financial technical analysis, a candlestick pattern is the price movement shown graphically on a candlestick chart for a specific period of time. Candlestick charts are used by traders to predict the future price movement based on past patterns. The recognition of the pattern is subjective, and there are programs for charting based on predefined rules to match the pattern. There are 42 recognized patterns. Some of them are simple and others more complex patterns. Something that most people don't know is how old candlestick charts are. They originated in Japan in the 1700s when a Japanese man named Homa discovered that. Despite the connection between the price of rice and its supply and demand, the markets were more influenced by the emotions of traders. Trading is often influenced by emotion, which can be read in candlestick charts. Candlesticks show this emotion in color. The different price movements are shown in different colors. Traders use the candlesticks to help them decide whether to trade by analyzing repeated patterns that can help determine the short-term direction of an instrument's price. Candlesticks are ideal for short-term traders as they can help them decide when to enter or exit a trade. Candlesticks are basically formed by the opening, high, low, and closing prices of a financial instrument. The main body of the candlestick is called the real body. The real body represents the price range between the open and close of that trading day. If the opening price is above the closing price, then the candlestick that is formed is filled and is usually red or black. If the closing price is higher than the opening price, the real body of the candlestick will be green or empty. In other words, the candlestick will appear white with a black outline. Traders can change the colors in their trading platform. For example, a down candle is often red instead of black, and up candles are often green instead of white. The lines above and below are known as shadows, tails, or wicks and represent the high and low price ranges within specified time period. However, not all candlesticks have shadows. In the next video, we will look at candlestick patterns in more detail. Stay tuned. Thank you so much for watching. Bye-bye.